Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. So what a week in the markets. We kicked off in full bullish fashion, riding the AI and tech waves and growing hopes for Fed rate cuts, only to get walloped in the back half by a sharp shift in trade rhetoric. Stocks sold off aggressively, yields dropped as investors sought safety, and gold surged to fresh highs. Now in this video, we're breaking down exactly how it all unfolded, what triggered the reversal, what sectors held up or didn't, what happened in bonds, and what to watch this week going forward. So with that, let's hop right in. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected 3.8% growth as of October 8th, which is the same as reported last week. Now, we may have some gaps in reporting because of the government shutdown, so keep a lookout. I will identify those key metrics, and this is one of them that we don't have updated data from last week. As mentioned on the previous slide, this data has also not been updated, so there's no update on the unemployment data this week, once again due to the government shutdown. And we'll continue to track this. Once data is reported, we'll certainly report that out as well. As you all know, we're watching mortgage rates very, very closely to see how home affordability is trending. This week, once again, we saw minimal movement in mortgage rates, where the 30-year and 15-year mortgage rates actually ended at 6.3% and 5.53% respectively. Now, investor sentiment was at the forefront this week, and should be, because there was a lot of fear in the market, as we'll talk about later. Now, one of the key metrics that we look at for investor sentiment is the bull-to-bear spread, which, interestingly enough, at this week ended at 10.23, showing that investors are actually feeling a little bit more bullish with the current environment. Ironically, the exact opposite of what we saw in the bull-to-bear spread is what we're seeing in the VIX. So the VIX is another measure of investor sentiment, and we very commonly call this the volatility index or the fear index. Remember, the VIX rises when stocks fall and declines when stocks rise, often showing an inverse price to action relationship. And VIX values above 30 are typically linked to large volatility resulting from increased uncertainty and fear, while values below 20 generally correspond to stable market periods. So this week, the VIX ended at 21.66. Another key metric that we're tracking is the probability of rate cuts in this upcoming cycle. So the currently CME FedWatch tool is calculating a 98.3% probability of a 0.25% decrease and a 1.7% probability of no decrease in October. Remember, these are based off of future contracts that are being tracked by the CME FedWatch tool. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and income, but only when considered together, ended negative 2.77%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was negative 3.68%. And the MSCI EFA, which tracks international stocks of developed countries across the globe, excluding the U.S., was negative 2.10%. It was a rough week for all indices last week. However, the smallest loser in this past week was international stocks. Now remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. So with that, let's jump right into our discussion around the contributors and detractors of the markets that moved these indices in the past week. We had a number of contributors that drove the markets last week. There was optimism earlier in the week that was driven by continued enthusiasm for companies involved in artificial intelligence, highlighted by the strategic partnerships like the one between AMD or Advanced Micro Devices and OpenAI, which boosted related tech stocks. Gold prices also hit a new record, surpassing $4,000 per ounce as investors sought safe haven assets during these growing uncertainty periods, helping gold mining stocks. Now, on the bonds or fixed income side, the primary drivers of the bond rally were investors' demand for safety amid geopolitical tensions, threats of larger tariffs on China, and concerns over weak U.S. economic data and prolonged government shutdown. Investors began pricing in a high probability of multiple Federal Reserve rate cuts by year-end, further fueling demand for treasuries and investment-grade credit. Municipal bonds also saw strong outperformance, strong performance thanks to positive fund inflows and well-received new issue calendar, leading to a flatter municipal yield curve. All right, so let's take a moment and talk about the key detractors this week. In the equity side, we saw the most significant market decline come on Friday after President Trump announced that he was considering a quote-unquote massive increase of tariffs on Chinese products. And all of this was in retaliation for China's new rare earth exports controls. This announcement triggered a strong global equity sell-off, and major indices like the S&P 500, we've talked about this, and the NASDAQ and the Dow Jones Industrial Average, all fell between 2.4 and 2.7%. There's continuing rising fears of a prolonged U.S. government shutdown and lack of new economic data also weighed in on sentiment. We also saw oil prices fall over 5% on Friday alone. This was hitting a 5-month low, which was near $58 per barrel. Most of this was due to both trade threats and to concerns of global oversupply. There's also continued concerns about slowing economic growth and persistent inflation, which contributed to broad-based weakness, especially impacting large-cap stocks like Amazon and Microsoft. Now, specifically on some sectors and stocks, we saw some sectors that were linked to consumer non-durables and health technology outperform, while healthcare as a broad sector continued to lag behind broad market performance. On the individual stock level for the quarter, companies such as Oracle, Apple, and Amphenol were among the contributors, with Intuit, Salesforce, and SAP acting like key detractors in many large cap portfolios. Now, on the bond side, last week the bond market saw a decline in the U.S. Treasury yields across the yield curve as investors reacted to political and economic uncertainty, especially because of the ongoing government shutdown and the renewed U.S.-China trade tensions. And we've talked about this a few times. The U.S. the 10-year Treasury yield fell sharply by the end of the week, closing at around 4.06, which is the lowest level seen in nearly 3 weeks, erasing earlier gains and reflecting strong demand for safe haven assets. Overall, the bond market action was defined by falling yields and a strong performance in both treasuries and credit sectors as heightened uncertainty boosted the appeal of fixed income assets. And friends, that concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Now, quick note that on Monday, October 27th, we'll be hosting a webinar talking about the behavioral aspect of finance. Tim Hilterman, our Chief Financial Planning Officer, Micah, who is one of our star associate financial advisors, and myself will be hosting this webinar. Now, we live in a world of numbers. We talk about this every week. Numbers, charts, and models where finance is often treated like a precise science. Yet anyone who's navigated markets, investment decisions, or personal finances knows that human behavior frequently throws a wrench into the quote-unquote rational machine. That is where behavioral finance comes in. The fascinating intersection between psychology and economics. So we'll explore how biases, heuristics, emotions, and social pressure shape financial decisions, often without us even realizing it. It's going to be a great webinar, so please make sure to tune in. And with that, thank you so much for watching. We look forward to seeing you next week.